Good morning. This is Ken Long from Tortoise Capital Management with a review of the weekend trading reports for October 20th, 2012. We've got a market that is in bullish normal conditions on an annual basis with weekly RSI 14. It's at 63 out of 100, so middle of neutral. 10-day NDX shows it oversold slightly at 18 out of 100, thus red. Percent stretch relative to the 200-day moving average is at 5.12%, yellow bullish, exhibiting a continued weakening state of the market here. The slope of the 50-day moving average is white bullish at 0.4%. ADX has dropped underneath 20 to rest at a neutral state of trendingness at 19.4, and the ATR percentage at 0.90% is normal. No change in the blended monthly rebalancing holdings. You can see the 26 and 13 ETF portfolios there, with the next reevaluation being on or about 1 November. In ETF2, the theoretical exposure is at 80%, and the model portfolio is still at 100% because the stops are still in effect. Here's a quick look at the 13 and the 26 ETF portfolios for a snapshot of current strength around the world. You can see technology, Japan, and treasuries are on a cash signal in the 13. The Qs, I think, because of that loss in the surprise loss in Google, and it's below its 4-month moving average. And at the top are the some internationals with Australia, Asia, less Japan, Euro-Asia index, the S&P itself, and then the big winners in the 26 ETF. Add Europe to that previous list, and financials, U.S. financials are strong as well. The health check. The vertical blue lines are 10, 20, and 30 days of look-back period. Horizontal purple line at about 147 and some change is the swing high, achieved back here in middle of September. Horizontal red lines are previous levels of support that have held. The blue river in the middle is the 30-period Bollinger Band plus or minus 1. Thin red line is the 50-day moving average. Thick red line is a 200-day moving average with the price below the 200 in the shaded red area to indicate traditional bear market areas. The thick green is the 10-period moving average, sort of a fair value marker, if you will. The black line in the middle, which just tipped negative, is the 30-period regression line, and the outer black line is a little bit hard to see there, are the regression channel that's formed by the maximum excursion from the regression line. So what it looks like for the past 30 days, we've been in this sideways cycling market. This has been good for the channeling system. You can see we're now near the bottom of that of the river, the Bollinger Band channel. In fact, we may have just snuck out of it, resting right on the 50, resting right at critical support at 142 and 3/4 ish, and a relatively tight Bollinger Band channel and price channel the last 30 days. That's really been the case for the last 60 days. There have been two strong one-day up moves, and that was the ECB announcement and then the Fed announcement. Everything else, if it hadn't been for those 2 days, we'd have been back in this previous 30 days of sideways, which I'm showing shaded yellow here. So we've had two sideways and now really a quiet channel. So the breakout from that sideways quiet channel is the way to play it. And you can see we've got an upside target of 147. If it breaks through this red line around 142 and 3/4, call it 143, it's a quick run now down to 139. That would bring it to a 5% pullback from the previous swing high. That would be well within the definition of market noise. A breakdown below 139, however, puts that whole bullish move described by the channel here into risk, and then 136 would be the next immediate target after 139. The chance that this 138 could hold, yeah, possible. But those are the big three markers that I see right there, about 143 139 and 136 are crucial. You can see on Williams percent R, we've left the bought conditions up here near the doji, and in one day gave it all back to rest just at about oversold on Williams percent R. It is oversold on the 10-day NDX. You can see we just finished a downward trend in percent price oscillator. The jaws opened briefly, but then have opened now to the downside. So in my view, we could see another leg down like this, which would equate to about another 3 or 4 percent drop down to 139. You see the ADX has declined. The trendiness has really just left the market. Bulls and bears are equally balanced. This is a perfect moment for swing traders who are able to go in both directions. I want you to notice there were some 5-day down opportunities in here. There was a 551W opportunity in here and in here. And if you can cash them when you get them, this is the kind of market that will be good for. These great big one-day directional moves are excellent for frog traders as well, because they can go in either direction as the price takes them along without a directional bias. I expect a big move day on Monday because it's resting at critical support levels based on daily and weekly numbers as well as our technical analysis here. So that's the health of the market right there. It's a weakening bull, has pulled back to a good move to get long, and then and stop and reverse for a nice short back to the 200-day moving average. Ideally positioned for a direction neutral swing trader. You can see here the summary of the ETF2 database by the regions. We get 2 that are below their moving average filter. That's Japan and technology, and that's why we're at 80% and 20% in the theoretical model. The S&P is stronger than EFA, and then SPY is the strongest inside the U.S., followed by tech, then the mid caps, and the small caps. The 2 strongest sectors are IEV, which is Europe, the European 350, and then Asia less Japan. I think that's that strength in Australia and in some of the commodities. World market model. Everything in the U.S. is below average now, with the exception of the S&P itself and mid-cap value. Europe has the strength. Anything Europe is strong. Asia less Japan is not bad. Inside Asia, less Japan, Australia, Hong Kong, but really India. Can remember about 3 months ago, India was at the very bottom of the stack, and so it pays you to observe where the extremes are and trade them accordingly. The extremes are extreme for a reason, but they can't stay there forever, and then they become value plays when they're at the bottom. Gold and silver leading the way among the other asset classes. Inside the business sectors, it's any finance right now, and even the defensive plays. Staples and utilities are weak. Only healthcare is above average among the defensive plays. Top ETF 30s. These are the most liquid and are liquid enough to own, and then the strongest based on the average score. Home construction, sovereign debt, Spain. Who'd have thought Spain would have been at the top of the list? Telecom, emerging markets, natural gas, Italy. Who'd have thought Italy and Spain were at the top of the list, or would be at the top of the list, based on pure price action? So choose your news and how you interpret it wisely. The Dow 30 now sorted by the strength column. Bank of America, that's not surprising. That has displaced Home Depot, and that's based on the strength in financials. J.P. Morgan, Merck, General Electric, Pfizer, Disney. At the bottom of the list, HP, Intel, Microsoft, Caterpillar, and McDonald's. Hard to see how the U.S. economy can get going without those 5. Even Coca-Cola's down there in the red. So for value players, that's some opportunities that I see. ETF liquidity, the top 30 based on daily dollar volume with exceptional volatile ATR percentages highlighted in green, and the others in red, though exceptionally quiet. Looking at the regression line crossover in the river for 4 assets here. The S&P is at a turning point here. It's been in the sideways channel, right at the Bollinger Band mean. The regression lines have met right at the mean. That's the definition of sideways quiet channel after a nice move up. The move down could be this large, from 140 to 130 was 10 points. So from here it could go from 145 to 135. That would be consistent with that last discussion. When the 30 rolls over and re-enters the river and fails at the Bollinger Band mean, it hasn't done that lately. The last time it did that was back here, and the move went from, was it almost a 10% pullback to the 200-day moving average. So it pays us to observe where the 30 is with respect to the river. IWM is a little more advanced in its failure. Gold has pulled back and just starting a sideways, what could be a sideways consolidation. Treasuries in the middle of the river after an extended period of oscillation. Look at how the 10 regression line has been bouncing. But if we see weakness up in here in the S&P, Treasuries are poised to make a run back to 130 once again. Okay, we'll move ahead now to the daily report. We've got channeling signals on technology and the Russell small caps here. You can see we got a bundle of channeling and overreaction signals in the large caps and in the ETFs. And in the auto framer, we have a bunch that test out very well at better than 2 to 1. Technology and IWM both in there as well. So that's, I think, a lucrative trade setup. Treasuries on a 551W. You can see how the volatility has left the building, but has recently gone from quiet back up into low normal. Remember, we're going to be dropping off high volatility days relatively here and adding current ones. So this is going to start feeling more and more like normal, and it'll start to the relative index will move up. Dow 30 tactical summary. You can see the top 5 in the max pain range compression. IBM, Intel, AT&T, Horizon, and Home Depot, of which AT&T and Intel test out at an exceptional 4 and 5 to 1 on the auto framer. And McDonald's has no other signals, but just on the auto framer alone, and the fact that it was down almost 5% on Friday makes it an exceptional one-day loser. An RSI 2 of 5. So it closed very, very poorly, as did IBM. There are some very good setups to look at there. Inside the ETF 30 tactical summary, lots of channeling and overreactions. There were no dojis. Friday was a directional day. You can see Treasuries testing out at 2.3 to 1 on the auto framer and are a 551 candidate, but meanwhile, max pain range compression signals in silver, gold, tech, and Russell small cap. So it's a market condition kind of day where we have some goodies going. Silver testing out at 4.7 to 1. I'm interested in silver at $31. You can see the 30-day regression line here and Friday's big directional down frog day. The regression line compared to its 10-period moving average still continuing to degrade, and is now back to the 6-month normal of sideways motion here. You can see how that choppy bull just really couldn't sustain and is now rolling back. The concern would be a move back to the 200-day moving average would cause that regression line to look like this previous sell-off, and you can see how fast that can go. Percent stretch is now below the 6-month average, getting close to a 1 standard deviation down move. This is a weakening bull right here. Nothing happy about that. The Z-score, the regression lines, you can see now the 90 has rolled over and getting ready to re-enter its plus or minus 1 standard deviation river. The 30 has rolled over and cross below the zero line, so it just tipped negative. The 10 period has bounced a couple times, but you got a series of lower highs. This would be a natural place for it to roll over if this is still going to be weak. I want you to notice that when even in that grinding bull, what you will notice is that the 10 period Z-score was contained by the 90 period. And now this last time it failed to get back to the Z-score of the 90, and so that's my concern on the downside, is that we've had 3 runs to try to break out, and we're in this chop waiting, I think, for the political decision to be made in a couple weeks, and that chop and volatility is more likely to be the case as we get more and more attempts to surprise and shock the voting sheep. But the bottom of the regression channel here, which has acted as support during this choppy bullish move, is now being tested for the second time, and that's not a good thing. I want you to notice in the previous example where we had failures and then grinding up moves, that the lower Bollinger Band period was acting as support, and when it failed, it was a sharp fail. So a sharp fail from here can get it down to 139 and 130 pretty quickly. Bollinger Band width extremely quiet, so we're poised for that sideways quiet channel breakout there. Just some reference data for the frog, reference data for the fail stat, and signal to noise ratio. I like this here in treasuries at 0.56, the most directional intraday of any of the symbols, and IEV and McDonald's. I mean, those are all symbols that we should be paying attention to once the directional moves start happening. The Z-scores for the different holding days, we're just looking at S&P 0.21, minus 0.46, minus 0.61, and 0.08, all within the bounds of normal. So we haven't seen the extreme move yet on those swing trade periods. Relative strength summaries, you can see the strength in Europe reversing that long, relatively weak period. Now everything Europe and international is moving up, while everything U.S. is failing except the mid-caps. Odd. Right at the lower boundary of the Elder Safe Zone channel, you see Friday's move really tested the lower limits. Was that a one-day anomaly reacting to Google, or is this part of a downward trend? Reference data, system quality number reference data, pivot point data, and these were all the things that violated their Elder Safe Zone channel. Correlation stats. So that's the review of the weekend report. Again, I'll just reinforce, I think we're at a perfect moment for swing traders to be able to enjoy 1 to 5 day moves in sudden sharp directions. I'm very cognizant of the downside risk. There's enough slack in that system to allow a 4 or 5% fail without really testing the boundaries of the bull market. And that will be good for people trying to tactically add to their inventory, but it's also poised at a place where we could see a serious run down of 10% from here. Upside, it's still got to get through 147 and hold and begin to extend itself. I have a hard time seeing that happening before November, but stranger things have happened. U.S. is just channeling sideways with a downward drift, while Europe and Asia, less Pacific, are playing catch-up. So that's the way to play it right now. Close to the vest and measure your risk, and have a very good reason why you want to hold something overnight. If you're the swing trader, watch that overnight risk. So that's Ken Long from Tortoise Capital with the review of the weekend reports. Good hunting.